Welcome back. So if you haven't watched the very first investment video that I released, all right, the link will be in the description below. Do watch that first before you come to part 2. All right. So today we'll be looking at a few different things, and the first thing that we'd like to talk about is what are some of the common mistakes to avoid when it comes to investment. For the first mistake that we want to look at is investing without a plan. All right, just imagine you're trying to get to a destination when you're on holiday. All right, and you're trying to blindly get there. You have no GPS, you have no navigation system, you're just hoping and praying that you reach your final destination with the right route. There's a very high chance that if you don't even know where your objective is in the first place, you don't even know where's your end goal, and you're just hoping for the best, there's a very high chance you might not even make it. The same can be said for any kind of investment strategy. All right, when it comes to investment, we need to have a right strategy in place, and hope, unfortunately, is not an investment strategy. We want to invest with money that you don't need for the short term, but want to grow for the long term. Mistake number 2, putting all your eggs into one basket. So for example, you don't want to be putting your entire life savings into a single company's stock, hoping, praying that it will magically go up and make you rich overnight. Or you might be thinking, well, my friend said this cryptocurrency is very good, it made him a lot of money, I'm going to do the same. So use some wisdom, use some diligence when it comes to that. One moment it might be very high, especially for cryptocurrency. The next moment it might be gone. It can be very volatile. So by diversifying your investments, you spread out the risk over different asset classes. If one does well, great. If one doesn't do as well, at least you're not fully affected. The one that is doing well is pulling up your overall investment portfolio. So don't put all your eggs into one basket. Mistake number 3, trying to get rich quick. One of the fastest way to get scammed is over promises of high returns. It sounds very appealing, very attractive. High returns of like 20% every single month guaranteed. Or sometimes we hear of people, colleagues, friends, family members who say they invested into this and it made them a lot of money. But when we hear all this, we always need to take into consideration what is the context behind it. What's the background? How long have they invested for? What is it exactly that they are investing in? Understand context and don't just hear it at surface level and accept it that, just because they said it made them money, it's guaranteed to be good. All right. What works for them might not work for you. Okay. So do your own research. So one of the things that, for example, is I'm not saying don't follow friends, colleagues, or family members' advice, but use wisdom because not everyone shares with you the full story. Personal investment can be sensitive, especially when it comes to finance. So understand they might not be sharing with you how much they put in, how they started, how much exactly was inside, what's the value today, were there any losses along the way? All right, so be mindful of that. On this note, I also like to say that if any kind of investment, if it sounds too good to be true, it probably is. If there are a lot of over guarantees, over promises, a lot of marketing to make it seem very attractive, it's probably a little good too good to be true. And sometimes when we hear, our colleagues, our friends, our family members sharing about how this investment is doing very well, use some wisdom to assess it. Is it suitable for my situation? Does it apply to my situation? If it's something that is you find that is helpful, it's good, maybe talk to someone that you trust, a trusted advisor, to find out a little bit more about it, do a little bit of research on about it before jumping into any kind of decisions. The last thing you want is that you get started on investment and then you end up losing some money, and then because of that it sours the family relationships or the friendship, something that we want to avoid. Now, the final mistake that people tend to make when it comes to investing is waiting too long to start. They keep waiting for the best time, the perfect moment, the ideal opportunity to go in. But the opportunity never comes, and time just passes them by. Okay? So I'm just going to give you an example of two different investors, investor A versus investor B. Investor A started 10 years earlier than investor B. Both of them are contributing $5,000 every year into the investment. But investor A had a head start of 10 years. So in total, because he had a head start of 10 years, in total he will have a $50,000 head start over a 10-year period. So he was very, very diligent. Every year, investor A will put in 5,000, 5,000 for 10 years. Investor B only started 10 years after investor A because he kept procrastinating. He kept delaying and delaying. He said, okay, maybe next year, maybe next time, I'll think about it. Okay, so when we look at the power of compound interest over a period of time, over a period of 20 years, let's assume that the investment over time, it grows at a rate of about, let's just use 7%. Okay, let's say it grows about 7%. We can see that for investor A, he started about 10 years earlier. Alright, at the end of 20 years, his value of investment would be $240,000. Oh, wow, that's quite a huge amount. Whereas for investor B, because he started 10 years later, all right, his value is only $84,000. That's a $155,000 difference just by starting 10 years later. And remember this, investor A had a $50,000 head start. Investor A had a $50,000 head start, but at the end of 20 years, that $50,000 head start became a $155,000 difference. So the power of compound interest of starting early, you can see it starts to take effect. You know, the earlier you start, the better results you'll see over time. So this is the example that I'm trying to illustrate about starting early rather than later. Now, I'd like to talk about some recent trends in investing. And one of the recent trends that we see over in recent years is the rise of this thing called fin-influencers or financial YouTubers. So in very simple terms, a fin-influencer is basically a financial influencer. It's just two words combined. And an influencer is someone who actually leverages on their social media channels, for example, like Instagram, YouTube, TikTok, to engage with their audience. And often they have some degree over their audience preferences, their behaviors. So influencers, they usually have quite a big following on the platform that they use, and they post content. It could be photos, videos, articles to interact with their followers, and a lot of times fin influencers means it's financial related. Okay, so their content usually revolves around providing advice on different financial topics, ranging from credit cards, which stocks to buy, which platforms to start investing, comparisons between different products, or sometimes even cryptocurrency investments. And sometimes they also do promote different types of financial products through their respective channels. And over the years, we can see that it's been growing in popularity. It's very easily accessible information. It's just very easy to just Google, and go online. There's a video talking about different aspects of finances. It makes it very easily accessible for most people. And I think one of the benefits that this has is that it simplifies a lot of complex topics. These influencers, they tend to do a pretty good job in making a lot of complex topics simple, easy to understand. People are able to follow along and understand, the different concepts about personal finance. So it helps to increase awareness over time. And also, I would feel that it's very expected that as followers or people who like their content, their followers will rely on them for financial advice or recommendations, and sometimes they might even act on those advice and recommendations. However, I think we have to weigh the cons as well. We have to be mindful of the cons as well. Let's take a look. So in this slide, I'd like to discuss opinion versus advice, because everyone is entitled to an opinion. Whenever you watch any kind of content online, it's an opinion. Right now, I'm also sharing my own opinion. You can choose to agree with it, you can choose to ignore it. While on the other hand, advice, when you look at all this information online, advice means, how does this relate to me? Does this piece of information resonate with my situation? We go online on the internet to learn about a lot of things. It's very easily accessible. If you see a topic that you're interested in, yeah, go ahead, do some research, find out a little bit more about it, watch videos about it, read articles. But if you find it a bit overwhelming, then consider speaking to a professional advisor who can relate to you and understand you and come up with a tailored approach, a tailored solution to the approach, so you are able to make a more informed decision on your own. So that is what I call advice. All right, so opinion versus advice, we need to know how to differentiate, okay? Because over time, even though we watch a lot of there's a lot of social media content from fin influencers, we need to have some critical thinking. Okay, we need to always verify and make sure that the information that they are sharing is correct and relatable to your situation. After all, personal finance is indeed personal. All right, what works for many may not work for all. Okay, just because it works for someone else doesn't mean it will work the same for you, for your exact situation. Be mindful of that. When it comes to watching fin influencers or financial YouTubers, we have to be mindful as well. All right, many of these fin influencers are not licensed financial advisors. They may appear to have a very large following and may sound very knowledgeable, but over time, if they are not inside the financial advisory industry. They are in the content creation industry. So on a day-to-day basis, they don't normally work or engage directly with clients. If you follow their videos, you tend to pick the stock and end up you lose money, it's your problem. There is no duty of care. All right, you are just a follower to them. Okay, so secondly, I think we have to be mindful, like any kind of influencers, one source of their revenue can be sponsorships that are or product endorsements. So in the case of fin influencers, such sponsors may actually pay them monetary or non-monetary compensation to exclusively promote or recommend certain financial products. So in such scenarios, right, the influencers could have maybe an ulterior motive or incentive to promote a particular product over other less risky or objectively better products, which could lead to their followers making suboptimal financial decisions. Okay, so again, it's just an opinion. What they're sharing is an opinion. It might not be advice that's relatable for you. And lastly, my personal, having been in the field for the last 9 years, I understand that financial products are extremely complex by nature. They are not designed for the layman in mind and may not always be explainable in very simple terms, right? Because sometimes in a bid to engage their followers with easily digestible information, fin influencers may sometimes oversimplify the nature of the financial product without fully explaining or disclosing the full risk of investing in the financial product. And sometimes this may lead to their followers making suboptimal financial choices. So exercise some wisdom, do your own due diligence with any kind of video or content that you watch. Remember, personal finance is indeed personal, and what works for one may not work for all. Now the question is, where do we start investing? So I've listed down a few common areas or more popular areas that people use when it comes to starting their investment journey. Number one is they can choose to do it themselves, all right, through the use of online brokers. Of course, the advantage is there's very low fees. You have your own account, you have 24/7 access to your account. But when it comes to online brokers, you need to know what to invest in. Your capital can be wiped out if you're not careful. You need to be able to select what type of investment, the right stock, whatever it is you're investing to, you need to be able to do the research on your own. And for people who are not very financially savvy, it can be very overwhelming, and there's also the potential for impulsive trading. One moment you see it go up a lot, and the next moment you want to put in some more money for it to go up even more, only for that same amount to, fall the next day. Be mindful of that. The next one is what we call robo-advisors. It's become very accessible over the last few years. I think it's a very low-cost way of automated investing. You just put in some money every month, all right? And they have an algorithm, they have a portfolio created for you. You just put into it, they help you to invest. Of course, the con is that there's a lack of human touch. If something goes wrong, if there's a market downturn and you're not very sure what to do, you may be a bit emotional, you're not very sure, you might create a bit of fear, panic, because there's no one you can talk to. You can't go and talk to their bot on their website to ask them how's the investment doing. They won't be able to give you that reassurance. And sometimes even for robo-advisors, you might be unfamiliar with what you're investing into. You're just trusting the algorithm, you're trusting that the portfolio is well taken care of for you. All right, so just be mindful. Of course, there's also free resources online. You can read books, you can watch YouTube content, you can read articles about investing. There's a lot of topics to cover about investment, and sometimes you can learn at your own pace. It's very good for people who like that, who like to read, who like to find out more. But of course, it can also lead to information overload. With so much information, where do you start exactly? Like, what's next? Okay. And the last one is, of course, you can consider talking to a financial advisor. So one of the advantages is that, of course, you'll be receiving personalized advice. The advisor will be able to understand your situation, and recommend a suitable investment product that relates to your situation. Okay. And over time, if the market doesn't do very well, there's a little bit of volatility, your advisor is there to reassure you, to help you understand what is happening, what is causing it, and what are the actions that you need to take. Okay. So, but of course, the con is that you have to pay a fee for it. There's no free lunch in this world. If you want good, you want fast, then you can't expect it to be cheap. All right. So there's going to be some fees involved, but of course, it will save you the time and energy when it comes to managing your own investment. And lastly, I think another con is that the quality can vary between advisors. In any kind of industry, there are good advisors, but there are also not so good advisors. So you need to know how to select the right advisor that has a similar values to you, that flows with your personality, and able to guide you correctly on your own investment journey. In summary, there is no one size fit all when it comes to investing. Firstly, for any kind of investment, you always have to make sure that you feel comfortable. What does your gut feel say when you start? You feel okay, or are you feeling, it's going to give you a bit of sleepless nights? Ask yourself, talk to your heart. If you're able to invest on your own, of course, do it yourself. If you're very financially savvy, you're very good with investments, you love this kind of stuff, by all means, do it yourself, manage it yourself. Of course, you definitely save on the fees. You don't have to pay anyone to help you do it. But this is people who have the time, they have the energy, and they just enjoy doing it on their own. Okay, so there's a group of people for this. But on the other hand, for people who don't want to do all this hands on their own, you can choose to talk to a trusted professional, to assist you, to help you save all the time and energy having to figure out what to do, where to start. You can do that as well. To speak to a trusted professional, someone that you have full confidence in, to learn more about investing. And lastly, have a long-term perspective. Don't expect quick returns overnight. Have a long-term perspective, manage your expectations, that over a period of time, if the investment that you choose is a good investment, you invest into the right companies, the right funds, with the right people managing it for you, you can expect that this investment will appreciate in the long run. As we end today, remember, investing is a marathon, it's not a sprint. Learn to enjoy the journey, enjoy the process. Start small, stay informed, and understand what you're investing into. Make sure it's something you're comfortable with. Understand the pros and the cons. Most importantly, be patient with yourself. So just think of investment like weight loss. You're trying to lose weight. You want to focus on the journey rather than the day-to-day ups and downs of your weight going up and down. Drink a bit of water, weight go up. Don't eat it for one day, your weight go down. So you don't want to be worrying about all these little fluctuations. Don't keep checking your investments every day. If not, your emotions may end up like you're on a roller coaster sometimes. Learn to let go, learn to be patient with yourself, and over time you'll see the results as long as you're investing into the right product. Thank you for watching. If you have any questions or you'd like to connect with me, you may scan the WhatsApp QR code on this page, or you can also drop me an email at hello@matthiasyeo.com. If you would like to find out more about myself, my services, my values, as well as my different client experiences, do check out my webpage, matthiasyeo.com. Thank you again for watching the video. I'll see you in the next one. Bye-bye.